Let me ask you something directly. If someone told you that turning 65 quietly moved you into a completely different category under federal and state law, a category that exempts you from bills you are almost certainly still paying right now, would you want to know which bills those are? Because that is exactly what happened the day you turned 65. And the reason most people never see a dollar of it is not complicated. The law does not collect this money and mail it back to you. The county that has been billing you for 40 years does not send a letter on your birthday saying you can stop. The agency that has been deducting money from your check does not flag your account and issue a refund. You have to know the exemption exists. You have to file the form. And that gap between being legally entitled and actually keeping the money is the most expensive gap in retirement. Before I walk you through what is on this list, I want to clear up something that causes people to tune out before they even hear it. Most people assume a list like this is only for people who are really struggling financially. If you own a home and you have some savings, you assume none of this applies to you. Other people assume the opposite. They think these kinds of benefits only exist for people with large estates and expensive advisors. So if they live mostly on Social Security, they assume none of it is for them either. Both of those assumptions are wrong, and both of them cost people thousands of dollars every year. Some of what I am going to tell you today helps the person living on a fixed income the most. Other pieces are worth the most to someone sitting on a home that has doubled or tripled in value over the past several years. On every single one, I am going to tell you exactly who benefits most, so nobody watching can honestly say that part is not for me. And if you are renting right now, do not go anywhere. One of the things on this list directly affects how fast your rent is allowed to increase, so this is for you too. My name is Linda Marsh. I have spent 13 years as a certified financial counselor working exclusively with Americans navigating retirement. And the most painful pattern I see, year after year, is not people making complicated mistakes. It is people who have done everything right their entire lives, quietly paying bills they were legally exempt from, simply because nobody sat them down and explained which form to file. There is no late notice for this kind of mistake, no penalty, no alarm, just money leaving your account every single month, every single year, that never had to leave at all. Let us fix that today. I am going to walk you through 5 things, one at a time, in plain language, with the exact action you need to take on each one. And I want you to stay all the way to the end, because the 5th one is simultaneously the highest value and the easiest to claim on this entire list. If you only act on one thing from this video, it is going to be that one. Let us start with number 1. And I am starting here because it is so new that the majority of people have not caught up to it yet. Starting with the 2025 tax year, every American who is 65 or older qualifies for a brand new additional deduction of $6,000. I want to be precise about this because people misunderstand it. This is not instead of your standard deduction. It does not replace anything you already get. It is an extra $6,000 removed from your taxable income on top of everything else. And if you are married and both you and your spouse are 65 or older, that is $6,000 each. $12,000 as a couple, stacked right on top of your regular deductions. This runs through the 2028 tax year. And here is the part that surprises almost everyone. It does not matter whether you itemize or take the standard deduction. Either way, you get it. There is an income phase-out. As a single filer, it begins reducing once your income exceeds $75,000. For married couples, the phase-out starts at $150,000. Above the upper limits, it disappears entirely. But think about who that leaves. The overwhelming majority of retired Americans. The person living on Social Security, a pension, and modest IRA withdrawals. That is precisely the person this deduction was designed for. And that is precisely the person most likely to miss it. Here is what I want you to do before you move on. If you have already filed your 2025 taxes, pull out that return right now and look for the additional senior deduction. If it is not there, you need to file an amended return using IRS Form 1040X. That deduction is yours and it can be recovered. If you have not yet filed, make sure your tax preparer or your software has your correct date of birth entered, because that is what triggers the deduction automatically. Number 2 is your property tax bill, and this is where the largest dollars on this entire list are sitting, for homeowners specifically. There are actually 3 separate forms that apply here, and most homeowners do not have a single one of them correctly filed. The first is the homestead exemption. What it does is remove a portion of your home's assessed value before the county calculates what you owe in taxes. In Florida, that amount is $50,000 removed from your home's value before they calculate your bill. In Texas, it is $100,000 off the school portion. Every state is different, but in nearly every state, it is real money. Here is where people get tripped up. Most homeowners assume the homestead exemption happens automatically when they purchase the home. In most states, it does not. You have to file a form with your county assessor, typically once, and in many states, you need to do it before a spring deadline. Miss it, and you pay the full unexempted bill for that entire year for no reason. The second form sits right on top of the first. It is the senior or age 65 exemption. Most states that offer a homestead exemption also offer a separate additional exemption that activates the year you turn 65. And this is the one your county assessor's office will almost never proactively notify you about. In Texas, every homeowner 65 and older receives an additional $10,000 off the school portion of their property tax, on top of the homestead. In Florida, the senior exemption can add another $50,000 on top of the basic $50,000, effectively doubling the exemption. And here is the part where I see comfortable homeowners incorrectly tune out. They hear the word senior exemption and assume there is an income test they will fail. In more than half the states that offer this exemption, there is no income test whatsoever. Texas, Florida, Georgia, Tennessee, Alabama, and many others. You turn 65, you file the form, you receive the exemption. Age is the only qualification. The third form is the most valuable of all 3. It is the senior assessment freeze. Here is what it does. When you turn 65 and you file the freeze application, your county locks in your home's taxable assessed value at whatever it is in the year you apply. From that point forward, it does not matter how much your neighborhood appreciates. It does not matter how much values climb on your street. Your property tax is calculated on that frozen number. In Texas, once you file the over 65 tax ceiling, your school district property tax is frozen at the actual dollar amount you paid that year. Your home's value can double. Your tax bill cannot rise. Who benefits most from all 3 of these? The basic homestead exemption helps lower-income homeowners the most in raw percentage terms, but the assessment freeze is worth a small fortune to the person sitting on a paid-off home that has tripled in value over the past decade, because they are the ones facing the largest potential increases. And renters, here is why this is also for you. Your landlord pays that property tax bill, and your landlord passes every dollar of that increase directly into your rent. When property tax bills are frozen or reduced across a community, rent pressure decreases with it. Number 3 is your Medicare Part B premium. This is the one that gets pulled from your Social Security check every single month before the money ever reaches your account, which means most people forget they are even paying it. It is simply gone before they see it. In 2026, the standard Medicare Part B premium is $202.90 per month. Automatic, every month. No invoice, no reminder. But here is what almost nobody is told at enrollment. There is a set of programs called Medicare Savings Programs, and if your income falls under the qualifying threshold, your state will pay that entire premium for you. Not reduce it, not discount it, pay it in full. There are 3 tiers. The most comprehensive tier, called QMB, or Qualified Medicare Beneficiary, does not just cover your monthly premium. It also eliminates most of your Medicare deductibles and copays, every doctor visit, every outpatient service. The cost reductions compound on top of each other. Here is what genuinely concerns me about this program. The income thresholds are significantly higher than most people assume. Many people glance at the program name, decide they earn too much, and never investigate further when they would actually qualify. Additionally, many states have eliminated asset limits for these programs entirely. That means your savings account balance, and in many states your paid-off home, do not disqualify you. Only your income is evaluated. Despite all of this, Medicare savings programs remain among the most underclaimed benefits in the entire retirement system. The people who would benefit most, those living primarily on Social Security, are the least likely to have ever heard the program name. The action here is one phone call. Call your local SHIP office. That stands for State Health Insurance Assistance Program. It is free. They will screen you for eligibility and help you apply at no cost. And while you have them on the phone, ask about one additional program that frequently travels alongside Medicare savings programs. It is called Extra Help, sometimes referred to as the Low-Income Subsidy. This program reduces what you pay for prescription drugs under Medicare Part D, your drug plan premium, your deductible, and your co-pays for individual medications. In many cases, qualifying for a Medicare savings program automatically enrolls you in Extra Help at the same time. Two of the largest cost reduction programs in Medicare, potentially unlocked by a single phone call. For someone taking multiple prescriptions each month, Extra Help can eliminate hundreds of dollars in annual drug costs. That is not a small number. Number 4 is smaller in dollars than the others, but it is still a bill you are likely paying in full when you do not have to. There is a federal program called Lifeline that provides approximately $9.25 per month off your phone or internet bill. Many states add their own discount on top of the federal amount, which increases the reduction further. And separately, if heating or cooling your home places a strain on your budget at any point during the year, there is a federal program called LIHEAP, the Low-Income Home Energy Assistance Program, that provides direct assistance with utility costs. I will be honest with you, $9 a month is not the number that changes your retirement. But it is one more recurring bill that the law has already decided people in your situation should not carry alone. And it requires exactly the same thing as every other item on this list. You have to ask for it. When you combine several of these together, the large ones and the smaller ones, the monthly total starts to move in a meaningful direction. Which brings me to number 5, the one I told you to stay for. Every American who files taxes at age 65 or older already receives an additional standard deduction that has existed in the tax code for years. This is separate from the new $6,000 bonus I described first. It is a second, entirely distinct senior add-on, and it has been available the entire time you have been retired. When you combine the regular standard deduction that everyone receives, plus this long-standing senior addition, plus the new $6,000 bonus that just came into effect, a very large number of Americans over 65 are paying significantly more in federal taxes than they actually owe. And a meaningful portion of them owe nothing at all. But here is the trap. Those same people continue over-withholding from their pension, their IRA withdrawals, and their Social Security out of pure habit. Nobody adjusted the withholding when they retired. Nobody recalculated what they actually owe now that they are 65 with the full stack of deductions applied. And so they send the government an interest-free loan every single year and treat it as normal. In my 13 years of working with retirees, this is the single most common and the single most fixable financial mistake I encounter. Not because people are careless, but because not one person in the system is set up to walk over and tell you that your situation changed and your withholding should change with it. Here is what I want you to do this week. When your tax return is prepared, confirm that both your regular standard deduction and your age 65 additional deduction were applied, and that the new $6,000 senior bonus was also included. Then ask whether your withholding from any pension or IRA distributions should be adjusted going forward. This is not a complicated conversation. It is one question, and the answer can put money back in your account every single month for the rest of your retirement. Now let me give you a few additional items for those of you who own a home with real value, because for the right person, these are worth more than everything else on this list. The first is property tax deferral. In a number of states, once you reach a qualifying age, you have the option to stop paying your property tax bill entirely. The state defers the amount owed and settles it later when the home is eventually sold. You retain your cash flow now. You keep your home. The tax is simply delayed rather than forgiven. The second is surviving spouse carryover. When one spouse passes away, the senior exemptions and assessment frees do not automatically transfer to the surviving spouse in many jurisdictions. Families lose these protections by accident in the worst possible year, when income drops and expenses are highest. But if the correct paperwork is filed, a surviving spouse can often preserve the deceased spouse's exemptions rather than watching the property tax bill reset. And the third is one that people are surprised to hear about. In a number of states, once you reach a qualifying age, your annual vehicle registration fees or excise taxes are reduced or eliminated entirely. The dollar amount is modest each year, but it is your money and it requires nothing more than a form. Let me bring this back to a real person. I once worked with a woman named Carol from outside of Columbus, Ohio. She was 71 years old, a widow, living in a paid-off home that had increased substantially in value over the years, and getting by on Social Security and a small pension. When we sat down together, here is what we found. She was paying the full Medicare Part B premium every single month, $202.90, when she likely qualified for a Medicare savings program that would have covered it entirely. She was paying the full property tax bill on her appreciated home, with none of the 3 exemptions on file. No homestead, no senior exemption, no assessment freeze. And she was having more federal tax withheld from her pension than she actually owed, because nobody had ever adjusted her withholding after she retired or applied her full senior deduction stack. 3 separate issues, all happening simultaneously, all invisible, all fixable with forms. We filed 3 applications: the Medicare Savings Program screening through her SHIP office, the senior exemption and assessment freeze with her county assessor, and a corrected withholding calculation for her pension. Nothing about Carol's life changed. She did not move, she did not sell anything, she did not make any major financial decisions. The only thing that changed was how much of her own money stayed in her account at the end of every month. And I want you to hear this clearly. Carol was not gaming the system. She was not exploiting a loophole. She was simply finally claiming what she had already earned over a lifetime of doing everything right. That is the entire point of what I am sharing with you today. Here is exactly what I want you to do this week. None of it costs $1. Number 1, call your county assessor's office. Ask them by name whether the homestead exemption, the senior exemption, and the assessment freeze are currently on file for your property. If any of them are missing, ask which form adds them and what the deadline is. Number 2, call your local SHIP office and ask them to screen you for a Medicare savings program. Ask about extra help at the same time. 1 call, 2 programs. Number 3, pull out your most recent tax return and confirm that both your senior additional deduction and the new $6,000 bonus deduction were applied. If either is missing, speak with your tax preparer about filing an amended return. Number 4, ask your tax preparer whether your current withholding from any pension or IRA distributions reflects your actual tax liability, or whether you are over-withholding out of habit. And if cost is any part of why you have been putting any of this off, know that you do not have to pay anyone to help you. There are 2 free programs staffed by IRS certified volunteers. One is called Tax Counseling for the Elderly. The other is AARP Tax Aid. They will prepare your return at no charge, and they know exactly which senior deductions to apply. The exemptions are real. The forms exist. The money is already there with your name on it. The only thing standing between you and it is knowing which form to file. If this video helped you today, do one thing for me in return. Send it to one person you know who is over 65. It costs you nothing, and it might put several $100s a month back in their pocket. I will see you in the next one.